So continuing on with adjusting entries. Next up are accruals. Let me find it. Okay, accruals means that nothing has yet been recognized for a particular revenue or expense. All right, so that means that there is no originating entry. And each adjusting entry will result or will include either a receivable or a payable. All right, so first up, accrued expenses. All right, the first example. All right, Smart Touch Learning pays its employee on a monthly salary of $2,400, half on the 15th and half on the first day of the next month. So the 15th is not a problem. It gets recorded the normal way. It would just be like salary, expense, and cash. But the last one doesn't get recorded until January 1st, but really they've earned it by December 30th. They're done earning it, and it needs to be recorded in that month. Okay, so our first one here is accrued salary or wages. This one happens to be salary. All right, so the adjusting entry would be on December 31st. And they need to accrue salary expense, but they haven't yet paid it yet. So the offset's going to be salary payable. All right, in this case for $1,200, so for half a month. All right, and that's at December 31st. When they actually pay it, I'm going to move over here. When paid, all right, it's going to get paid on January 2nd, well, 1st, I guess. I don't know. That's a Sunday, so I don't know about that. But when they actually pay it, it's going to be a debit to salary payable and a credit to cash for the $1,200. And as you can see, there is no effect on the income statement for the current year. All right, because the expense was properly matched to revenue over here in the preceding year. Okay, interest expense is another one. Accrued interest expense. When you borrow money from the bank, you generally have to pay interest on it. And it starts accruing from the time that you borrow the money. But you don't typically pay the interest until you actually pay the note back. Okay? All right, so in this case, Smart Touch Learning borrowed $60,000 on December 1st. All right, at December 31st, they owe $100 worth of interest on the note. All right, so the adjusting entry at December 31st would be interest expense, and we'll learn how to calculate it in a later chapter, and interest payable for $100. And then next year, when we actually pay the note off, we'll pay off this $100 that's an interest payable, and then we'll have interest expense for whatever's remaining. All right, accrued revenue is where I have earned some revenue, but I haven't recorded it yet. So I've earned some revenue, but have not yet recorded it. So my adjusting entry for that. All right, here's what's always going to be: accounts receivable and service revenue. So in this case, we agreed to perform e-learning services for $1,600 a month. This is on December 15th. By the end of December, has earned half of the monthly fee. They haven't been paid yet, but they've earned half of it. All right, so on December 31st, I need to record an account receivable because they owe me $800 at this point. And I'm going to credit service revenue. All right, so here's a good thing to look over. It does kind of a overview of everything that we did. All right, so this is, goodness, I'm sure it's somewhere in your book, but I don't have a book with me. Exhibit 3-3. I don't know if it's the same one in your book or not, but you might want to find this in your book. And then here they all are, written together journal entry wise. Okay, so then the next step, I don't know if you remember that little accounting cycle that I did back in the beginning. So I did this accounting cycle list, and there were a couple steps to it. So the first step was journalize daily transactions, and we did that in chapter 2. The second step was to post to the general ledger. We also did that in chapter 2. The third step was a trial balance. That was chapter 2 as well. All right, fourth is adjusting entries, which is what we just did. And post them. Okay, post to the accounts. Then you do an adjusted trial balance, which is what they're talking about here. All right, and the adjusted trial balance is to make sure that everything still balances out. All right, and then you could do your financial statements. Those stay the same as what we've done all along. So our financial statements are the income statements, balance sheet. Oh, let me do statement of retained earnings first. Statement of retained earnings and the balance sheet. Then we would do closing entries, which is chapter 4, and a post-closing trial balance, which is also chapter 4. Okay, so here's the adjusted trial balance. So it's the same thing as a trial balance, but it's after you've posted your adjusting entries. All right, let's see what last little things are left in this chapter. Well, you might read this. This is just, if you don't do your adjusting journal entries, then your income statement and your balance sheet are not correct. You won't have a test on this, but you might want to look over how it affects your income statement and your balance sheet. All right, for instance, if I forget to accrue this revenue, then my net income is going to be too low and my assets are going to be too low. And we're not, well, we will do a worksheet in lab. You can refer back to this in lab though. Okay, so here's a worksheet that it's a thing that stays in Office and it helps you put all the information in one spot. So if you might notice, they have the unadjusted trial balance, the adjustments, you add or subtract going across, that gives you the adjusted trial balance. And then you can go on further and do the financial statement columns, and it helps you to do your income statement and your balance sheet. But we do that in a lab. And I think we're at the appendix now, and we're not going to do that. Actually, if this is appendix 3.7, this might have been an appendix as well. Maybe not. Okay. All right, so we're done. Look for homework videos or in-class solution videos.